Now we're going to examine the prohibited trading practices that you'll find within trading markets. This is an important topic. Duly note this information. You'll want to be able to identify each of these prohibited trading practices clearly. Now that we know how the trading markets work, we'll also need to know those explicit activities that are prohibited by the SEC. Those prohibited trading practices are as follows. Front running. This is trading ahead of a customer's order. A trader on the floor of the New York Stock Exchange gets a customer's order, calls a friend, and then tells the friend about it. The friend then enters an order ahead of the customer's. That is front running, and both the tipper and tippee are liable for this illegal violation. Trading ahead of research. If a firm will be issuing a research report on a company that is likely to impact the market price of the stock, the firm's market-making desk cannot alter its inventory position in anticipation of that report. Trading ahead of a customer's order. A customer has entered a limit order. The firm must execute the customer's limit order at that price before it can execute an order for its own behalf. Trading pools. These are groups of investors who trade back and forward with each other in order to move the price when no actual ownership change is taking place. Wash sales. This is buying and selling securities to create the appearance of a trade on the ticker. Wash trades. Therefore, this will entice people to the market when no actual significant change of ownership is taking place. Marking the market at the open and marking the close. This is entering transactions either at the open of the market or at the close of the market that suggests that some big event is going to occur that could affect how the price of the stock opens or closes. This is manipulative. Interpositioning. This is when a firm gets an order from a customer, and instead of routing it directly to a market maker, the firm routes it to a middle firm and then routes it to the market maker, in effect increasing the cost of the transaction. Interpositioning is prohibited. Shredding. This is the dividing a large trade into smaller units so that it can be routed to different markets to increase the payments that the firm receives for the order flow. Shredding is prohibited. And finally, a firm cannot act as both a broker and a dealer in the same transaction. A broker takes a commission, and a dealer sells in and out of its own inventory. The firm can only act as one or the other, never both in the same transaction. In this video, I have given you some dynamic examples to reinforce this information. If you need to, review these videos again. Also, use the textbooks and audiobooks as reference. In addition to order types, I've also covered some of the standard conventions used within trading markets, and I've talked about prohibited trading practices. Remember that millionaires will be made at millionairesintraining.com, so study thoroughly and you will pass your SIE exam.